I'm always ready to rock. It's amazing, it's beautiful, it's wonderful. COVID, market uncertainty, inflation. To say the past few years have been challenging is an understatement. But the reality is, even before the challenges grabbing headlines today, the world, and specifically the investment world, has been undergoing significant structural change. And despite countless financial innovations, in many ways, today's wealth advisors and their clients have seen remarkably little in the way of better solutions to manage risk and reward. Sure, there's plenty of products to slam into a portfolio, but let me ask you, are you, or more importantly your clients, sleeping any better at night? Rather than blow up your entire process or pile on exotic investments in the name of greater diversification, a better Sharpe ratio, or whatever you're chasing, we at Halo believe there's a better way to invest. As a global leader in protective investments, Halo is on a mission to make structured notes accessible to every investor, regardless of portfolio size or sophistication. To help make this a reality, Halo partners with wealth advisors like you to make it easier to add protective investments into a client's portfolio or into your own model allocation. Accessibility and education are one thing, but stepping forward as an innovator in portfolio construction is another. Which is why Halo is proud to introduce a more efficient way to use structured notes, the Hedged Equity Strategy. To complement, even enhance existing equity portfolios, Halo is working with wealth advisors to layer structured notes as an efficient way to hedge equity risks, and there are plenty of them. With Halo's new model allocation framework, equity portfolios can be enhanced with structured notes by layering these solutions on top of existing long equity positions. This helps clients retain upside potential, which we know clients tend to prefer, but a level of downside protection is added through a structured note to defend against the unforeseen. By rethinking the classic core satellite portfolio, which Halo calls Core Satellite 2.0, we can position structured notes as a core equity holding within the equity sleeve of your portfolio. It's not an alternative investment. This approach captures the upside potential in the markets, but adds a meaningful level of downside protection against market declines. This is particularly important when diversification doesn't work like it used to, for example in 2022, or when clients are uncomfortable stepping into the market for fear of losing more money. Beyond a simple and powerful hedge against market drawdowns, layering structured notes on top of long equities can also hedge against manager underperformance if you're using active managers. As we all know, active management has struggled over the last decade, so the layering approach with structured notes can protect, if you will, against both active manager underperformance and declines in the broader market. It's like a two-way hedge. If active management makes a comeback, you can get the double bonus of the manager's outperformance plus the upside you can get from the structured note. In summary, we think this layering approach is an important step in helping wealth managers meet client demands. And it's not just Halo saying this. 1 in 3 investors say they'll likely use structured notes within the next 2 years. This pent-up demand shouldn't really surprise anyone. Investors today expect a better investment experience. And to get there, asset allocation and the wealth manager's value proposition is evolving from just simply maximizing return or reducing asset volatility. A manager's value proposition is centered around both. Adding structured notes to your practice is easier than you think. Halo's here to help.